Welcome back to Mr. Money TV, the channel that makes financial education fun. And this is the story of Bitcoin. It's the year of 2008, a dark year for the world economy. It was the global financial crisis, a financial crisis that started in the US and spread throughout the world. The cause? A flawed banking system and the greed of big banks executives and those who have influence over the banking system. It was said that the US government spent close to $500 billion in taxpayers' money to help the economy to recover. At the same time, the culprits of the financial market crash, the big banks executive and the people in power got away scot-free. Not just scot-free, but with a big fat paycheck, so fat they never need to worry about working again for the rest of their lives. All this at the expense of 10 million Americans losing their homes due to their irresponsible and unethical practices. In August 2008, a mysterious individual by the name of Satoshi Nakamoto registered a domain, bitcoin.org, and published a paper titled Bitcoin, a peer-to-peer electronic cash system. Bitcoin is a digital currency system that's created in response to the flawed banking system. It's a currency that will not be affected by irresponsible behavior of greedy executives or policymakers. So, how is this electronic cash system or digital currency different from our normal financial system? To understand this, we have to understand how traditional money that we use today works. The money we use today, our currency, is issued, monitored and controlled by the government through a central bank. And one of the most common methods the government uses to control money is by printing money. Yep, you heard it right. The government can print money as they see fit. If they need more money, they can just print it. Like in the year of 2008, the financial crisis, when the US government needed more money to help bail out the big banks that caused the financial crisis, they just print more money and voila, problem solved. But there's a problem with this. The thing is, just like anything else in the world, currency too follows the law of supply and demand, where the value of an item increases when the supply is low. But the value of an item will decrease when the supply is high. So when too much of money is printed, the oversupply of money leads to a decrease in value of money. This is also known as inflation, which is the reduction of buying power of our money over time. Every economy will have a healthy dose of inflation. Unfortunately, too much of it will lead to hyperinflation, and that can potentially cause a country to collapse. Yes, collapse. Like what we see in Venezuela, where a cup of coffee can cost $1 million of their currency, and that same cup of coffee can cost $2 million the following month, which goes to show the frightening rate of devaluation of their currency. It will say that if you want to rob a person in Venezuela, take their clothes and leave the money. It's worth nothing. Now that we know government control the currency they issue and they can manipulate the supply as they see fit, we know that the government is made up of politicians, and historically, most people don't trust politicians, and as a result, don't trust the government. The truth is, nobody wants to hold a currency that can be easily manipulated and unstable. Before government-issued currencies were the thing, people would use gold as the preferred currency when it comes to doing business internationally. Instead of having people to pay them in their government-issued currency, businesses would prefer gold as a currency to conduct trades, since its value is more stable. Why? Because no government can simply print more gold whenever they need, making the value of gold more stable. Before the year of 1913, even when government-issued currencies became more widely used by people, most countries would peg or fix their currency to gold, and this was called the gold standard. The gold standard simply means a government national policy where they fix their currency value against the value of gold. For example, in the UK, £100 is fixed at the value of 1 gram of gold, and maybe in Malaysia, 100 ringgit is fixed to 0.5 grams of gold. In other words, if you sold something to the UK and it's worth £100, you can either choose to receive it in £100 currency notes or 1 gram of gold. because you will be getting the same value either way. And for most governments at that time, the amount of money they have is equal to the amount of gold they have in their keeping. So the currencies at the time were much more stable. But everything would change after World War. During the war, most governments resorted to printing more money to finance their war effort, leading them to abandon the gold standard. After the war, most countries barely have much gold left in their keeping, except for the United States of America, which still keep the gold standard for their currency. So, after the war, the world leaders gathered and agreed to fix their currency value against the US dollar, making it the preferred trade currency for any global trades. The idea is, since the US dollar is still using the gold standard, the belief is that by fixing their currency against the US dollar, they are indirectly fixing their currency against the gold standard. Fast forward to today. Although the USD is no longer using the gold standard, it is still the preferred currency for any part of the world. With the US growing in influence alongside the increased use of USD, it eventually became the largest economy in the world. Since the USD remains the most important currency today and most countries still have their money fixed against the value of USD, this means that the stability of the US dollar has a huge impact on the global economy, and whoever who controls the US dollar policy controls the world economy. We can see the impact of the US dollar and economy had on the global market in the year of 2008. When the financial markets in the US crashed, it turned into a global economic crisis. And this leads us back to the story of Satoshi Nakamoto. Satoshi wanted to create a currency system that is not controlled by any government or individual, thus the creation of Bitcoin, a digital currency system. But what is Bitcoin and why is it so revolutionary? For traditional currencies, we store our money in our bank account and the bank keeps track of our money. If we use it or add more money, they will know because they keep a record in their ledger, which is reflected in our bank statement, also known as our money movement. This is extremely important because it tells us and others whether do we really have enough money to spend. Imagine, if the bank doesn't take record of your money movement, you will likely spend and spend, thinking you have enough money in your bank account. And the sellers will not receive their money after selling you something. To protect you and those who do business with you, the bank keeps a centralized ledger. Putting it this way, when people do business with you, they trust the bank has verified that you really have money in your bank account to pay them. While we are comfortable with this system, there are a few potential problems. Firstly, the intermediaries will charge you a fee for using their service, and this fee can be really expensive. Well, as we can see, it's not cheap to run a bank, right? Secondly, the centralized ledger can potentially be manipulated by someone who has control or influence over the intermediary. And as we know through history, humans are not to be trusted generally. And this was the biggest problem for any form of currency, because whoever controls the central ledger can manipulate the system. So, how do we solve these two problems? By doing away with intermediaries like banks and others that charge a high fee and are vulnerable to the manipulation of greedy people. But the problem is, someone has got to keep a ledger, right? And track the money movement. If not, who knows whether there's really money in someone's bank account or not? And in that case, who can we trust? Satoshi's Bitcoin solved this problem using a technology called blockchain. While this can be a really complicated technology, the core concept is that it's a digital ledger that compiles all transactions that have ever happened for every single transaction that was done with every single unit of the digital currency. Since the ledger now is open to everyone to verify and scrutinize, it's hard or almost impossible for anyone to manipulate the ledger because everyone is watching and can automatically check and balance the digital ledger. And this is the concept of decentralization of blockchain. Well, if you still find this confusing, think of it this way. Traditional companies will always hire an auditor to audit their accounts and hopefully approve their financial statement. Companies who want to cheat on their financial statement will work with their auditors to approve a manipulated financial statement. And that's like traditional money. Bitcoin, on the other hand, is like a company who doesn't hire an auditor, but instead invite every auditor in the world to audit their accounts, making sure that there's no financial manipulation. And each auditor will perform a check and balance with one another that makes it impossible to be biased. And that is the idea of blockchain's decentralization. Because of this, you can do business directly with one another without going through any intermediary. This would mean low transaction fees. But what about privacy? If everyone can read the ledger, then there's no more privacy, right? Well, here is where your Bitcoin account name will simply be a series of numbers. So only the account holder will know their own account number. And a Bitcoin owner can remain anonymous as long as he prefers to. So here you have a currency that is not controlled by someone, low transaction fee, and anonymity. What other reasons do you need to invest in Bitcoin? Remember we talked about supply and demand? The blockchain of Bitcoin is programmed to only issue 21 million units of Bitcoin. This limited number of Bitcoin would mean that the value of Bitcoin will increase over time as the demand increases while the supply remains the same, thus leading to a higher value. Here we can see that Bitcoin is very similar to gold. And just like how people would invest in gold to keep the value of their money, they would invest in Bitcoin. For some, Bitcoin is even better than gold. Well, it's much cheaper and easier to store and carry around 10 Bitcoin than 10 kg of gold bars, right? And the transaction fees are lower when you make payment in Bitcoins. The limited amount of Bitcoin issued will likely lead to an increase in value. And finally, that those who prefer to keep their identity anonymous can enjoy privacy in Bitcoin. Bitcoin was the first of the cryptocurrencies. And today, more and more people are starting to see cryptocurrencies as an alternative investment and a currency that can hold the value of their money, just like how people perceive gold in the past. Bitcoin is just like a digital gold. It was indeed revolutionary. It was not just about digital money, but more importantly, the technology that powers it. A technology that's said to be able to change the world, blockchain. And today, we can see more and more cryptocurrencies surfacing. One of it is Ethereum, which opened our eyes to how cryptocurrency can be used to create a more transparent governance. And if you're interested in investing in Bitcoin or other cryptocurrencies, you can use Luno, a regulated cryptocurrency platform in Malaysia. You can read about it in the description below.